Silver demand faces an inflation shock, and the problem is its double identity. Silver can attract investors as an inflation hedge, but more than half of global demand comes from industrial use. That means higher prices, higher rates, and weaker manufacturing can hit the same metal that some investors buy for protection. The tension is not simply inflation equals bullish. For silver, inflation can also damage the factories that consume it. The immediate pressure point is CPI, PPI, manufacturing PMI, central bank meetings, the dollar, $28 support, and $32 resistance, because the first reaction only matters if those signals confirm it rather than fade. The confirmed context is that silver is heavily used in electronics, solar panels, and automotive systems. Those sectors depend on production volumes and financing conditions. If inflation raises input costs, companies may slow output or delay expansion plans. Solar is especially important because silver paste is a key component, but the projects are capital-intensive. Higher financing costs can delay installations and reduce near-term metal demand. This baseline keeps the story grounded in silver demand is under threat from an inflation shock because industrial users may cut production or delay expansion and prevents early attention from being treated as final proof. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. The mechanism is demand destruction. Silver demand faces pressure when central banks respond to inflation with higher interest rates because silver offers no yield and competes with interest-bearing assets. At the same time, manufacturers facing higher costs may produce less. That makes silver different from gold. Gold has less industrial exposure, while silver can be pulled lower if investors start pricing in weaker growth across industrial metals. Mechanically, silver acts as both a monetary metal and an industrial input, so higher rates and factory weakness can pull in different directions. That link is what turns the headline into a concrete risk, access change, liquidity test, or adoption signal. The impact reaches metals traders and the industries that rely on silver inputs. Electronics manufacturers face higher costs for components. Automakers using silver in electrical systems and sensors can reduce demand if vehicle production slows. Solar developers can delay projects if financing becomes expensive. For crypto viewers who track macro liquidity, the silver signal is useful because it shows whether inflation is moving from a price problem into a growth problem. The affected side is specific. Manufacturers, metals traders, and macro investors need to track whether inflation protection is outweighed by industrial slowdown. That group feels the practical consequence before the wider market has a settled answer. What remains unclear is which side of silver dominates. If inflation cools without a hard slowdown, industrial demand can recover and silver may hold up better. If central banks overtight or manufacturing PMIs weaken, the industrial side may overpower the hedge argument. The current market levels do not settle that debate. Support near $28 and resistance near $32 are the zones that show whether traders are accepting or rejecting the risk. The limit is also specific. Silver can still attract hedge demand, but demand destruction becomes a risk if manufacturing slows harder. Keeping that limit visible prevents uncertain data from being treated as certainty. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. For silver demand faces pressure, the next signal is manufacturing data alongside inflation reports. Watch CPI, PPI, PMI readings, central bank guidance, the dollar, and the $28 to $32 price range. If factories keep slowing, silver's industrial demand risk becomes more important. If inflation cools while production holds, the threat eases. The practical readout is whether silver trades like a hedge or like a cyclical metal. A stronger follow-through would show up through CPI, PPI, manufacturing PMI, central bank meetings, the dollar, $28 support, and $32 resistance. A weaker read would appear if those signals fade or fail to confirm.